If you receive Social Security in 2026, do not assume the increase shown in your COLA notice is the same increase that will reach your bank account. The average retirement benefit went up by about $56 a month, but Medicare premiums also increased. If you are working, crossing the new earnings limit could cause part of your benefits to be withheld. Some SSI recipients will see no deposit during certain calendar months because their payment arrived early. And if you worked as a teacher, police officer, firefighter, government employee, or in another job with a pension that did not pay into Social Security, you may still need to take action to receive every benefit available to you. Nothing in this video means Social Security has suddenly disappeared, but misunderstanding one small rule could leave you confused, worried, or temporarily short of money. Stay with me until the end because I will explain the most important 2026 changes in plain English and give you a simple checklist you can use to review your own benefits. Before we begin, please subscribe and turn on notifications. This channel shares clear and timely updates about Social Security retirement, SSI, SSDI, Medicare, survivor benefits, and the rules that can affect your monthly payment. You should not have to read complicated government documents just to understand your own money. Subscribing is free, and it can help you hear about an important deadline or payment change before it becomes a problem. Let us start with the update affecting the largest number of people. Social Security and SSI benefits received a 2.8% cost of living adjustment for 2026. This increase is called the COLA. It is designed to help benefits keep up with inflation. It is not a special bonus, it is not a separate stimulus payment, and it is not an additional check that everyone must claim. If you were already receiving an eligible Social Security benefit, the adjustment was generally added automatically. You did not need to complete an application or pay anyone to receive it. A 2.8% increase does not mean everyone receives the same number of extra dollars. It means your gross benefit was generally increased by 2.8% before deductions. A person with a smaller benefit receives a smaller dollar increase, while a person with a larger benefit receives a larger dollar increase. For a simple example, a gross benefit of $1,500 would increase by approximately $42 before Medicare premiums, taxes, overpayment collections, or other deductions. A $2,000 benefit would rise by approximately $56. Your actual calculation may differ slightly because Social Security uses your official benefit amount and applies its rounding rules. According to the official 2026 figures, the estimated average benefit for all retired workers increased from about $2,015 to $2,071 a month. That is an average increase of about $56. The estimated average for an older couple who both receive benefits increased from about $3,120 to $3,208. The estimated average benefit for a widow or widower living alone increased from about $1,867 to $1,919. These are national averages, not promises about what any individual must receive. This distinction is important because some videos and social media posts take an average benefit and present it as though every senior is entitled to that amount. That is not how Social Security works. Your retirement benefit is connected to your earnings record, the age at which you claimed, and other details in your case. The safest way to find your personal gross amount is to read your COLA notice, check your benefit verification letter, or sign into your official My Social Security account. When reviewing your deposit, compare gross benefit to gross benefit and net deposit to net deposit. Do not compare last year's gross benefit with this year's bank deposit because deductions can make that comparison misleading. Medicare is one reason your net increase may be smaller than expected. The standard Medicare Part B premium is $202.90 per month in 2026. It was $185 in 2025. So the standard premium increased by $17.90. For someone receiving the average $56 gross Social Security B increase and paying the standard Part B premium through automatic deduction, a basic comparison would leave approximately $38.10 of the increase before considering any other changes. That is only an illustration. Your result may be different because not everyone pays the standard premium and not everyone has Part B deducted from Social Security. The annual Part B deductible is also higher in 2026. It is $283 before original Medicare begins paying its share of many Part B covered services. After meeting that deductible, a person with original Medicare will commonly pay 20% of the Medicare approved amount for covered services, unless another form of insurance helps with that cost. Medicare Advantage, Medigap, Medicaid, retiree coverage, and employer coverage can all change what a person pays. So do not assume that a neighbor's medical costs will be the same as yours. Some higher income beneficiaries pay more than the standard Part B premium because of the income-related monthly adjustment amount, commonly called IRMAA. For 2026 premiums, Medicare generally looks at income reported on your 2024 federal tax return. That 2-year look back can create a problem if your income has fallen since 2024 because you retired, reduced your work, divorced, lost a spouse, or experienced another qualifying life-changing event. If Social Security is using an older income year that no longer reflects your situation, read your premium notice carefully. You may be able to request a new determination and provide evidence of the change. Do not simply accept an unusually high premium without first checking why it was calculated. Now let us discuss SSI, because SSI is not the same program as Social Security retirement. The maximum federal SSI payment for 2026 is $994 per month for an eligible individual and $1,491 for an eligible couple. Those are maximum federal amounts, not guaranteed payments. Your actual SSI can be lower because of countable income, your living arrangement, help you receive from other people, or certain income belonging to a spouse. Some states add a supplemental payment, which means the total can also vary depending on where you live. A person should not take the maximum SSI amount and add it to the maximum Social Security retirement amount and assume both can be collected in full. Social Security retirement income is generally counted when SSI is calculated after applicable exclusions. A person with a small Social Security benefit may qualify for some SSI, but receiving one program can affect the amount paid by the other. If your total income and resources are limited, it can still be worth checking eligibility instead of assuming that a small retirement benefit automatically disqualifies you. One difficult part of SSI is that the basic resource limits remain very low. In 2026, the federal resource limit is generally $2,000 for an individual and $3,000 for a couple. Not everything you own is necessarily counted. For example, the home you live in and usually one vehicle may be excluded, but money in bank accounts and many other assets can count. Because these rules are detailed, do not give away money. Remove your name from property or make a major financial decision based only on a short online video. Ask Social Security how a specific resource would be treated before changing it. If you receive SSI, report changes in income, resources, address, marriage, household members, and living arrangements when required. A change that seems unimportant to you can affect SSI. Reporting it promptly can help prevent an overpayment that Social Security may later ask you to repay. Keep copies of documents you submit. Write down the date of any phone call and record the name of the representative when possible. Good records can become extremely valuable if there is a disagreement months later. The next major update affects people who receive retirement benefits while continuing to work. If you are below full retirement age for all of 2026, the annual earnings limit is $24,480. If your counted earnings exceed that amount, Social Security generally withholds $1 in benefits for every $2 earned above the limit. The word earnings is important. For this test, Social Security generally counts wages from a job and net earnings from self-employment. Pensions, investment income, interest, annuities, and capital gains are generally not counted as wages under the retirement earnings test. Imagine that a 64-year-old beneficiary earns $30,480 during 2026. That is $6,000 above the $24,480 limit. Social Security could withhold $3,000 in benefits because the rule is $1 withheld for every $2 above the limit. Social Security may withhold entire monthly payments until it reaches the required amount, so the effect may not appear as a small equal deduction every month. That is why working beneficiaries should report expected earnings and update that estimate if their work changes. A different limit applies during the year in which you reach full retirement age. If you reach full retirement age in 2026, the higher limit is $65,160, and only earnings received before the month you reach full retirement age are considered under this special rule. Social Security generally withholds $1 for every $3 earned above that higher limit. Beginning with the month you reach full retirement age, the earnings limit disappears. You can earn any amount from work without the retirement earnings test withholding part of your Social Security retirement benefit. Benefits withheld under the earnings test are not treated exactly like a fine or a tax. When you reach full retirement age, Social Security can recalculate your benefit to give you credit for months in which benefits were withheld. That can increase your future monthly amount. However, this does not mean you immediately receive one large refund of everything withheld. It may take time for the higher future payments to make up the difference. If you need every monthly payment for rent, food, and medicine, plan carefully before combining early retirement benefits with substantial work. Full retirement age is another subject that causes confusion. For people born in 1960 or later, full retirement age is 67. People reaching their full retirement age during much of 2026 were generally born in 1959, and their full retirement age is 66 years and 10 months. Full retirement age is not the earliest age at which most workers can claim. Retirement benefits can generally begin at 62, but claiming early causes a permanent reduction compared with waiting until full retirement age. For someone whose full retirement age is 67, starting retirement at 62 can reduce the worker's monthly benefit by as much as 30%. Waiting beyond full retirement age can increase the worker's benefit through delayed retirement credits until age 70. For many people in this age group, those credits equal about 8% for each full year of delay before considering future COLAs. There is generally no additional delayed retirement credit for waiting beyond 70. But the best claiming age is personal. Health, employment, savings, family needs, life expectancy, taxes, and survivor protection can all matter. Spousal and survivor benefits also follow different rules. A spouse's benefit does not earn delayed retirement credits in the same way as a worker's own retirement benefit. Survivor benefits offer different timing choices, and in some situations, a surviving spouse may be able to start one benefit first and switch to another later. Before making a permanent claiming decision, ask Social Security for estimates at several ages. Do not rely only on a single number displayed by an online calculator. For people still building eligibility, the amount needed to earn one Social Security work credit is $1,890 in 2026. A worker can earn no more than 4 credits in 1 year, which requires $7,560 in covered earnings for all 4 credits. Most workers need 40 credits to qualify for retirement benefits, which is commonly described as about 10 years of covered work. Credits determine whether you are insured for benefits, but they do not determine the size of your retirement payment by themselves. The benefit calculation usually looks at your highest 35 years of Social Security covered earnings. If you have fewer than 35 years, 0 earning years can enter the calculation and lower your average. Continuing to work may help if a new year of earnings replaces an older low year or a 0. Social Security reviews work records and can recalculate benefits when new earnings increase the calculation. This is one reason a person who is already receiving retirement benefits may later notice a modest increase not connected to the annual COLA. Check your earnings record at least once a year. A missing or incorrect year can reduce your future retirement, disability, or survivor benefit. Compare the record with W-2 forms, tax returns, and self-employment records. Correcting an error is usually easier when you still have the documents than it is many years later. Also remember that cash work on which Social Security taxes were never paid may not appear on the record and may not build benefits. The maximum taxable earnings amount also changed in 2026. Social Security payroll tax applies to covered earnings up to $184,500. This number is sometimes wrongly described as the maximum amount a retiree is allowed to earn. It is not. It is the wage base used for Social Security payroll taxes. Employees generally pay 6.2%, and employers pay another 6.2% on covered wages up to that amount. Self-employed workers generally pay the combined Social Security rate through self-employment tax. Medicare tax does not use the same wage cap. Do not confuse the taxable wage maximum with the retirement earnings limit. The $184,500 figure concerns payroll taxes. The $24,480 and $65,160 figures concern benefit withholding for certain people working before full retirement age. These rules have different purposes and apply in different situations. The maximum possible retirement benefit also increased, but very few people qualify for it. In 2026, the maximum is listed as $2,969 per month for a worker retiring at 62. $4,152 for a worker retiring at full retirement age, and $5,181 for a worker retiring at 70. These numbers are not standard benefit amounts. Reaching the maximum generally requires very high Social Security covered earnings over a long career. If someone tells every senior that they can claim a $5,181 monthly check simply by completing a new form, that claim is misleading. Now we need to talk about federal taxes. Social Security benefits can be taxable even after you retire. The IRS generally uses a calculation sometimes called combined income. In simple terms, it includes 1/2 of your Social Security benefits plus other income, including tax-exempt interest. If you file as an individual, part of your benefits may become taxable when combined income exceeds $25,000. If combined income is between $25,000 and $34,000, up to 50% of benefits may be included in taxable income. Above $34,000, up to 85% may be included. For married couples filing jointly, the basic thresholds are $32,000 and $44,000. Up to 50% of benefits may become taxable between those amounts, and up to 85% may be included above $44,000. Saying that 85% of Social Security can be taxable does not mean the government takes 85% of your check. It means up to 85% may be included when taxable income is calculated. The tax you actually owe depends on your full return and tax rate. SSI payments are not federally taxable because the basic taxation thresholds have not automatically risen with every COLA. A benefit increase can sometimes push more income into the taxable calculation. Withdrawals from traditional retirement accounts, wages, pensions, and investment income can also affect the result. If you expect to owe tax, Social Security allows eligible beneficiaries to request federal withholding from monthly payments at certain fixed percentages. This may help prevent an unexpected bill, but a tax professional can help you decide what fits your situation. Another important development involves people whose benefits were previously reduced by the windfall elimination provision or government pension offset. The Social Security Fairness Act ended WEP and GPO for benefits payable from January 2024 forward. These rules had affected more than 2.8 million people with pensions from work that was not covered by Social Security, including some teachers, police officers, firefighters, federal employees under the older civil service retirement system, and people with certain foreign pensions. Social Security began adjusting affected payments and issuing retroactive amounts during 2025. By 2026, many eligible people should already see the higher amount. However, review your notice and payment history if you believe WEP or GPO previously reduced your benefit. More importantly, if you never applied for a spouse's or survivor's benefit because the old GPO rule would have eliminated it, do not assume Social Security will automatically create a claim for you. Contact Social Security and ask whether you now need to apply. Ending an offset does not always replace the need for a formal benefit application. Payment dates are also creating confusion in 2026. For most people who began receiving Social Security after April 1997, payments are based on birth date. Birthdays from the 1st through the 10th are normally paid on the second Wednesday. Birthdays from the 11th through the 20th are normally paid on the third Wednesday. Birthdays from the 21st through the 31st are normally paid on the fourth Wednesday. People who receive Social Security before May 1997 or who receive both Social Security and SSI may follow a different schedule. SSI is usually scheduled for the first day of the month. When the first falls on a weekend or federal holiday, the payment is sent on the preceding business day. That does not create an extra benefit. It only moves the regular payment earlier. For example, the August 2026 SSI payment is scheduled for Friday, July 31st, because August 1st falls on a Saturday. The November SSI payment is scheduled for Friday, October 30th, because November 1st falls on a Sunday. This means an SSI recipient may see no new SSI deposit during August or November, but the benefit was not canceled. It arrived early and must last through the month it was intended to cover. Paper checks are also being phased out. Social Security has said it plans to complete its transition to electronic payments during 2026. If you still receive a paper check, contact Social Security or the Treasury using information from an official government website and ask about direct deposit, the Direct Express card, or whether you qualify for a rare waiver. Never give your Social Security number or banking information to a person who calls unexpectedly and offers to activate your payment. Social Security will not require payment through gift cards, cryptocurrency, cash, or a wire transfer to protect your benefits. If Social Security says you were overpaid, do not ignore the notice. Under the current recovery information, if no repayment, appeal, or waiver action is taken within the stated period, Social Security may automatically withhold 50% of a regular Social Security benefit or 10% of an SSI payment each month. That can create a serious household emergency. Read the notice immediately and confirm the deadline. An overpayment notice is not necessarily the final word. If you believe the amount or reason is wrong, you can request reconsideration. If the overpayment was not your fault and repayment would be unfair or create financial hardship under the rules, you may request a waiver. If you agree that money is owed but cannot afford the proposed withholding, you can request a lower recovery rate. Taking action within 30 days of the notice can generally stop collection while a timely appeal or waiver request is being considered. Keep proof of when you submitted everything. Finally, you may have heard claims that Social Security is going bankrupt and that checks are ending in 2026. That is not what the official 2026 trustees report says. The report does identify a serious long-term financing shortfall. Under its intermediate projection, the Retirement and Survivor Trust Fund reserves could be depleted in the fourth quarter of 2032 if lawmakers make no changes. Ongoing income at that point is projected to cover about 78% of scheduled retirement and survivor benefits. That requires attention from lawmakers, but it does not mean current checks stop in 2026. And it does not mean Social Security suddenly has no incoming revenue. Here's what I want you to do after this video. First, find your 2026 benefit notice and identify your gross monthly benefit. Second, look for Medicare, tax, or overpayment deductions and calculate your expected net deposit. Third, if you are working before full retirement age, estimate your 2026 wages and compare them with the correct earnings limit. Fourth, review your Social Security earnings record for missing years. Fifth, if you have a government or foreign pension, check whether WEP or GPO ever affected you and whether a new application is needed. Sixth, confirm that your direct deposit information is correct. And seventh, open every official Social Security letter as soon as it arrives because appeal deadlines matter. The most important truth is that there is no single 2026 increase, deduction, or rule that affects every senior in exactly the same way. The COLA is real, but Medicare can reduce the amount you feel in your monthly budget. The earnings limits are higher, but they matter only to certain people working before full retirement age. SSI maximums increased, but income and resource rules still control the actual payment. WEP and GPO ended, but some people may still need to apply. Payment dates can move, but an early deposit is not an extra check. Understanding these differences is how you protect yourself from confusion and misleading promises. Use official notices for your personal amount and never rush into a financial decision because a video says that every senior must act today. This information is educational and cannot replace individual advice from Social Security, Medicare, or a qualified tax or financial professional. If this explanation helped you, subscribe, turn on notifications, and share it with another senior or family member. A simple explanation shared at the right time could prevent someone from missing a payment, losing an appeal deadline, or believing a false promise about their benefits.